In the stock market, understanding the dynamics between smart money and dumb money is essential for successful trading. Smart money understands market psychology, accumulating positions when panic strikes and exiting as euphoria takes hold. On the other hand, dumb money tends to follow the crowd, fueled by social media hype and fear of missing out. This often leads to poor timing, particularly evident in their tendency to buy at the peak and sell during downturns. Consequently, it becomes vital for individual traders to distinguish between these two entities, aligning their strategies with the more disciplined, strategic approaches of smart money. Adopting these practices can shift a trader's mindset from reactive to proactive, ultimately leading to greater success in the stock market. By recognizing the patterns of smart money, traders can learn to navigate the markets more effectively. For instance, during the accumulation phase, the market often appears dull, but these price movers are quietly building their positions. When manipulation occurs, the market may show fake breakdowns designed to shake out the unsuspecting retail traders. This phase is crucial for smart money, allowing them to position before significant expansions, which lead to noteworthy breakouts. As prices rise, the euphoric feeling sets in, but it's during this distribution phase that smart money chooses to sell, often at the expense of the retail crowd. Understanding these cycles helps traders align their buying and selling strategies so they can operate with the confidence of institutional investors, optimizing their entries and exits to maximize potential returns. To successfully navigate the complexities of the stock market, one must be vigilant and aware of the repetitive nature of these cycles. By recognizing the signs of accumulation, manipulation, and distribution, individual traders can develop a keen sense for identifying optimal entry and exit points. This intuitive understanding separates successful investors from those who unknowingly fall prey to market traps set by smart money, ultimately fostering a healthier approach to trading that champions informed decision-making. Embracing this disciplined mindset equips traders to withstand the inevitable market fluctuations that accompany the financial landscape, ensuring they emerge stronger and more astute. In conclusion, understanding the interplay of smart money and dumb money not only enhances trading strategies, but also empowers individuals to make informed decisions in the face of market volatility. By aligning with the practices of smart money, traders can navigate cycles more effectively, ensuring long-term success in the stock market.